Hello and welcome to our March. Today is the 1st of March, our Switzer webinar. The first Friday of every month we do this webinar, and of course I'm joined by Peter Switzer. Peter, how are you?
I'm very good. How are you?
I'm feeling pretty good. We're actually in different offices today, hence that's why you're seeing Peter and myself differently on the screen. And next to me is Shawn Burns. Shawn, of course, is the portfolio manager with Contango, and he's also the portfolio manager for the Switzer Dividend Growth Fund.
That's correct.
Great to have you here, Shawn.
Good to be here, Paul.
Okay, so just before we get started, there's a couple of things that on sort of a housekeeping nature that I need to remind you of, and obviously just to point out is the obligatory disclaimer. Now we say that it is important, of course, is that we don't know anything about your personal financial situation, your investment objectives, or your particular needs. So anything we're talking about here is not personal advice. And if you really hear something and we always suggest that you should go and talk to a professional advisor before acting upon it. So we can't be responsible for knowing whether it's appropriate for you, and what might be appropriate for one person or one type of investor may not be appropriate for another. So it is general nature, and as always, seek appropriate professional advice. The other thing from a housekeeping point of view, if I could just navigate the screen here. Okay, is that we ask you to please close all the applications and programs that are not in use. Please ensure the volume of your computer or speakers is turned up to a comfortable level. And of course, this is an interactive webinar, and you can send questions during the webinar, of course, using the drop box at the bottom of the right hand of your screen. Type in the questions, and we'll try to get to as many of those as we can. Okay, so let's look. We did head this webinar is about looking at some great great income stocks out of reporting season. Let me just start off by just looking at some figures for the month of February in the market, and also just look at the sectors and get some comments from both Peter and Shawn. Look, pretty good month, 6% if you add in the dividends, and so 10.1% in 2 months is a pretty good start to the financial year, the calendar year, one of the best starts I think I can remember. So we've come back all the way from those lows we had in mid-December, and we're up 10.1% year to date. Just one other take there is that in February, the bigger stocks led the market higher. I think that's a function more of the banks, but 6.6%. The so-called mid-cap 50, which are stocks numbers 51 to 100 by market cap, they're actually been lagging a little bit so far, and the smaller caps are doing all right. So it's a little bit perverse in that respect. The top end of the market and the bottom end of the market, the stocks doing better than the stocks in the middle. If you go to the sectors, of course, they were. I'm just trying to bring the slide back. The 11 industry sectors. So we have in the data, we've got the weighting, that's the relevant, how big the sector is a part of the S&P ASX 200. We have their returns, and of course we always look at the accumulation index, which of course adds in dividends, and that's what really as shareholders you get. So most people in the market talk about price returns, we talk about accumulation returns. So looking at the sectors, every sector bar consumer staples in the green in February. The standout, of course, is financials, up 9.1%. And can't say I'm surprised by that, because probably you're not surprised, Peter. We've been saying that for a long time. There was too much Royal Commission gloom and doom. But I think the other take on a year-to-date basis is the materials, and that's really led by the standout increase in the iron ore price. Perhaps some of us didn't see. Energy is really strong, and some of the sort of so-called growth sectors, a bit more economic-related things like, just sort of starting to lag just a touch. So, but an overall fairly even performance, I think, would be my take. Now, that's my commentary. So, Shawn, just you sort of taken what's happened the last 2 months and whether that tells as much as we look forward. We want to go forward now.
Yeah, I think that what's become apparent is that sell-off, that severe sell-off late last year was overdone. I think that the fears of some type of economic meltdown, which the market was sort of like starting to price in with those huge falls, hasn't eventuated, and I think we're seeing the return to more normal levels. So the market's been strong into this year. Result season in Australia was there were some pretty low expectations coming off the end of last year, just how bad things were. I mean, it wasn't a great result season, but compared to the expectations, which were quite low, it ended up being okay.
Let's come back to result season. Let me just do a little bit further. Is there any surprise there for you in terms of which parts or components of the market are doing better or worse so far this year?
I think not on the underlying earnings. I think that there weren't too many big deviations there. We know the resources are benefiting from high commodity prices at the moment, especially iron ore. Industrial struggling a bit, and we know the economic conditions aren't great, but they're not too bad. There's been input costs sort of like putting a bit of pressure on it. The dividends were quite interesting though, going into this year. I think that into this result season that we saw the boards being reasonably cautious overall, but they were sort of spiced with some pretty big payouts as companies cleared their franking accounts.
Okay, so let me turn to you, Peter. Any reaction to that sort of data and what it means perhaps going forward?
Well, a couple of things. I do remember around the middle of the year when you and I got together with Shawn, and Shawn was feeling the pressure of the financials and Telstra having an absolute shocker. And I think he kind of didn't want to dump the banks, but he asked us the objective question, what do we think? And both you and I said, we've got to stick with them because we believe that the Royal Commission was ridiculous in the way that it punished, effectively, indirectly punished the stock price of the financials. So I was really glad that we bullied Shawn to do what he really wanted to do. So I always remember that particular day. We all kind of agreed, but you had to at least ask the question, do you think I should lighten up on financials? And we didn't. I'm really happy about that. Paul, one of the real shiners of the year has been consumer discretionary, up 11.1%, at a time when everyone keeps telling us that retail's getting a clobbering. Shawn, have you been able to work out how come consumer discretionary is doing so well, yet we keep talking about retail doing so badly?
I think it's against expectations, Peter. So expectations are quite low. When you look at the short positions in some of those retail stocks like JB Hi-Fi, etc., there's big short. So people are betting that they're going to get hard times, and I mean it hasn't been. And we've had a series of profit warnings from several of the retailers, and you saw Harvey Norman's results. I mean Australia's still struggling, but not a disaster. They're sort of hanging in there. The expectation's so low that every time there's sort of that was okay, the stock prices sort of have a bit of a gallop. And so I think that's what's going on there. And, Harvey Norman had pretty good growth overseas as well, so that helped them. So low expectations and there's some good retailers out there, they're hanging in there.
Yeah, it's interesting because one of the triggers was Kathmandu not doing really well. But I thought to myself, Kathmandu's hardly a bellwether retailer, I would have thought.
Yeah, look, I think, Peter, you're right, low expectations. I mean, it's a funny market because, as Shawn said, a lot of stocks are short. There are people talk their book. I remember when these short sellers to get into stocks, they then talk to all the journalists. They tell everyone how bad it's all going to be. You've got to be really careful about the information you're getting because it's often people talking their books, just like people talk their books in their long stocks. And, fund managers are really good at that.
Oh, they never talk up this stuff.
No. Well, the negative talk often is the reverse because people are already short. So just be wary of that, and just unfortunately the financial press are good mouthpieces for that sort of stuff. But anyhow, let me just move on because I think we've covered what happened. I want to just go back to, if I can just go to reporting season. Just want to move that forward. Why can't I move? Okay. So let's just go to reporting season. Shawn, any it was a tad disappointing, I think.
Yeah.
Any key themes that come out of it for you?
I think we've had the top lines slowing down. So I think Australia's just...
So that top line, you mean sales?
Yeah,
revenue?
sales,
Yep.
revenues slowing down, margins under a little bit of pressure, input costs going up. So you saw, several of the companies sort of getting a little bit of a squeeze there. Not dramatic, though. And I suppose there's a bit of uncertainty as people look forward. I don't think the outlook statements were that great. I think people are sort of and companies sort of battening down the hatches a bit for let's see what happens this year. A few companies saying, this could be a bit of a tough year and we're preparing for it. So that was, the market sort of reacted. I think if Australia's lagged a bit, but a bit of relief rally, expectations quite low again. So at the end of it, probably not a great result season, but enough to keep those low expectations satisfied.
Is it just now a weight of money argument? I think look back at reporting season and why the market has actually done better than the US in February.
Yeah.
And arguably it's done as well so far this year as the US market has now. And sure, we were probably a bit more beaten up and everyone was bearish and a lot of the fundies in November and December and got that very wrong. But, if you look at it, what's happened is that companies are awash with cash. They're awash with giving returns back to shareholders. So we've seen this enormous increase in special dividends, off-market buybacks, supersized ordinary dividends. Look, partly driven by Bill Shorten's plan around franking credits, partly driven by the resource companies coming to the end of their sales process, and BHP and Rio have just sold all their assets and now got so much cash and are returning it. But that's all got to go somewhere, and it's all happened at the same time as the expectation around interest rates is now... People now talking.
You look at what happened in the last quarter last year. There's the stock market plummeting and people saying how far is world growth going to come off? It's slowing. We're going in another recession. All the, that sort of now we're starting to get the figures that was okay. We had credit spreads sort of sell off really badly at the end of the year. Now they've rallied all the way back. So it looks, bond market sort of stabilising. Sort of looks okay again. Growth. Interest rates low, some positive growth, so it starts to look back to that trajectory that we had for the start of last year.
Peter, do you want to add to that, or you've?
Yeah, I think, remember, the sell-off was huge. Then the Fed turned around and said, we might not raise interest rates this year, so they got everyone optimistic. But because this economy is mixed, and I think the results were mixed, and I don't think a lot of CEOs have the confidence to be predicting a bold year ahead, because there are so many question marks. So I just think that what we saw was probably what you expect in a mixed economy. And I'm just hoping that GDP next week is better than expected and we gradually start crawling out of this, I hope, bottoming of the economy, bottoming of house price falls. And we might actually get a bit of a surprise in the second half.
Yeah, I think that, in terms of our portfolio, the banks are always a big part. They're yielding... grossed up 8-9%, and so I think now we're outside of the RC. That it's not a great trajectory in terms of growth, pretty flat, but they will stabilise. They have been pretty cheap, and they're starting to solidify, I think, around these levels. The other stocks. We have been buying a fair few of the REITs over the end of last year. So the REIT market's basically split in two. You've got the retail and residential that people don't like, and the industrial and commercial that people like. So we've sort of got a foot in each camp there. One's got a high yield compared to the other one. Also, I think there's a lot of medium-sized companies that, corporate Australia has got pretty good balance sheets. So we saw Caltex, which we own, is handing back its franking credits off market buyback. I think that there's which is good, handing those franking credits back. But the balance sheets in corporate Australia are very good. It's like there's no sign of distress or risk in terms of balance sheets. So they're prepared, which is a good thing for dividends because less chance they'll cut their dividends.
Okay, so really need you mentioned the banks and
Caltex.
Caltex. Any others? Just I want you to get here, really knock them out, Shawn. Come right to it with a couple of your number 1 or 2 stocks that you like, right?
I mean, we've been buying the insurers as well.
So,
we like the IAG and Suncorp in the fund. I think they're diversified away from the banks. Insurance markets have been strong, so they got knocked around a bit on credit spreads and the equity markets at the end of last year. That's come back now. So I think those dividends should be good news going forward. Where Suncorp's has sold its life business, so they got capital hand back. So that should be coming back to shareholders. The supermarkets, they had pretty average results in there, but we are holding Wesfarmers as well, and they just paid out another huge dividend as well, which is if we go to energy, our stock is Woodside. They paid out a big dividend, so we got some big dividends coming through the fund right at the moment, and they'll go through. So that's sort of like the crux of our and with those REITs as well. Okay, Peter, you want to nominate any?
I got to say, after having to spend the afternoon with Jerry Harvey yesterday, Harvey Norman's now around 8.5%. I got to say, I do like the fact that they're growing their overseas business, and I also do like, and it quite surprised me, he thinks the Reserve Bank's going to cut interest rates by 0.5%, and if they do, I think that will actually kickstart the economy a bit as well. And as I say, 8.5% before franking, it's not bad for I think it's a pretty safe business. It's never going to shoot the lights out. He bought $80 million worth of stock when it was $2.50 something during that sell-off. And also, like Jerry owns 55% of this company. You've got a fair bit of skin in the game. So that's one stock I like. I also like, and I know I'm going to be a bit biased here, but I do like Switz, SWTZ, because I've got someone great like Shawn Burns, looking every day for those sort of income stocks that we miss in our busy daily lives. And of course, when it got down to, how low did it get, Shawn? $2.23 or something?
Yeah, that's correct, Peter.
Like the yield must have got well over 10, 12% just then. So I think it's always a good stock to think about when the market's selling off, because the dividends are going to be fairly reliable with this stock, isn't it, Shawn?
Should be. I think, as I said, those balance sheets are pretty good. So I think that, even if we see as long as it doesn't get into a fully blown recession or anything, we don't see that. Even in tough periods, the balance sheets of the companies we own are pretty good, I think. So hopefully those dividends are protected.
Yeah.
I wrote a brilliant piece in the Switzer Report this week. I nominated 5 stocks. So let me just recap on what they were. So with some trepidation, firstly, Woodside. I'm very wary about resource stocks, but Woodside, I think, has the cash flow, the balance sheet, and I think they want to take on partners for their projects. So as long as they're trying to find partners, I don't think the balance sheet looks all right. So Woodside's number 1. Transurban, simply because that monopoly continues. It may be a little expensive at $12.50, but that's just a stock to buy on weakness. There is a bit of behaviour change going on there where the traffic's not growing at quite so much, but if you look at their model, they can still probably comfortably get away with 5 or 6% increase per annum. Coles, which reported badly. I've been bearish on Coles, but around $11. I think it's pretty safe. It's not going to shoot the lights out. I said it's a buy at around $11 to sell at $13. It's not the classic demerger, so just caution people that have been writing the demerger story on Coles. Fourth one's Medibank. I haven't been a fan of Medibank, but for the first time it actually reported a policyholder increase. So it's actually stopped the sort of the challenge that most number ones have in market of losing market share, and actually started to grow its policyholders again. And I'm just stretching to think what the 5th one was, but I'll come back to that shortly. So there are sort of 4 suggestions, and I'll think of quickly what my 5th suggestion is. So on that note, I'm sure it'll come to you. There are some income stocks to consider. Okay, so what we might do is we start with your questions. We've got quite a few that have already come in, and they're not always going to be on income, obviously. But look, this is a good one for you, Shawn, because I know Switch does have some gold, which always worries me a little bit. But what's your, we have a gold miner, but what's your view on gold stocks? And has the game played again with interest rates now not going up? What do you?
Gold's a very difficult one. It's like a currency. What drives gold is I've been doing this for 30 years. I don't think I found a good answer to that. In real interest rates, inflation, US dollar, etc., they all seem to play a part in it. And I'd say that what the gold price does is the biggest determinant of gold stocks, and that's a bit of a question mark. I mean, in terms of gold stocks, I think probably Evolution is probably one of the better ones in to have a look at that, though. In terms of yield, if you want to have a yield play, gold's probably not the area to really to focus on too much, because you get volatility in the gold price and trying to so I think they are inherently trading counters, so that's the way we look at them.
And what would be your number one gold stock?
I think we've actually just sold out. We had some Newcrest, we've sold it this week, so we're taking profits in that. Always good to take profits in gold stocks, I think, Paul. So if you get profits in that, decent profits, you take them. I think that probably in terms of a well-run gold stock is Evolution, so I'd have a look at that one if you're keen on gold. It's well-run and it's got some fiscal discipline around it.
Okay, Peter, view on gold. I know I'm a gold bear. I'm always a gold bear. Everyone understood the need for gold, but look, do you have a preferred gold stock, Peter?
My problem with gold is I just don't understand it. I never ever invest in anything which there are too many curveballs. But I do love this story which came out, which tells us a lot. December 27, right? And it says, and the story says that gold is in the box seat for 2019. But listen to the opening line. With continued global uncertainty showing no signs of abating, 2019 is shaping up for what could be a bumpy year for ASX-listed gold stocks, probably written by a gold company. But the thing is I think uncertainty has abated. The Fed's promised basically not to raise interest rates unless it has to. Donald Trump looks like he's going to get a trade deal. Even Brexit's starting to look pretty sensible. So therefore, I don't think gold is as an important play as it was, say, late December. And one last thing, Julia Lee on my TV program on Monday pointed out a number of very senior directors of gold companies selling their gold stocks, and that's not a good sign.
Okay. All right. Well, I'm probably with you, Peter, but we've got a couple of suggestions about gold anyhow. Look, the other income stock I liked was APA, which, of course, is the pipeline operator. You're not going to get super rich out of it, but always like stocks where someone wants to buy. There's a takeover offer and it fails for FIRB reasons. It means that other people see more value there. This Chinese company was trying to pay $11. It's still well below that. It's a steady income operator. It's not exciting, but it came off too fast. So that was the other stock and reported okay. Okay, let's go on to Rio. Now, I wrote about this yesterday. I'm interested. This is a question that says that, well, Rio's got to where it has largely because of the accident in Brazil. I think you've got to understand that. What's happened to the iron ore price is because Vale, the operator and the biggest producer in the world, I think Vale is, have had a lot of their production curtailed, particularly anything involving a dam where there's upstream storage. So the iron ore market has been disrupted not by so much increased demand for iron ore, but because one of the major producers can't produce or has cut production. So that's why Rio's up there at 94. So I'm just wondering what your take on both Rio and BHP and Fortescue at the moment are.
Oh, we're sellers. I mean, I think that that these are pretty high prices. It depends on your time frame. What could go wrong with selling them now is if President Xi up there in China suddenly goes and has puts a pedal down, let's go for growth, and gets people excited, or the Vale problems escalate. That's basically, I think, what is the risk to the upside. That the iron ore price goes higher. Otherwise, it's from our point of view, it's difficult if you look out 6 months or 12 months that you'll see these prices. So that's so we think it's a reasonable selling for Rio and probably Hills as well, BHP.
Yeah, look, I'm definitely in the profit-taking camp on those stocks. I thought it was, if you actually, and you can download this if you don't get the investor presentations, and I encourage anyone out there who's got time to look at them. But really interesting about the Rio investor presentation, which is available, is that the first two slides, I've never seen this before, talk about their tailings dams, how many they've got, and how they're managing on that. And that tells you that Rio and investors are starting to say, hang on, there's a bit of an issue here and we've got to understand this risk. And Rio has something like 100 different dams, tailings dams, that operates globally. Some are closed and on watch, but
very sensitive now.
It's a very sensitive
issue now.
I think this heightened awareness amongst the big resource companies about some of the risks they're running with this stuff. So
the other thing with Rio, of course, it's got that huge dividend that goes ex next week.
Yeah, and that's going to be worth something like about $5.80. So on the 7th of March, when it trades ex, you'll see the share price probably fall by $6, a bit more than $6. So that'll have a big impact on the index, at least the price index. Everyone tells you that trading day was bad. Part of it will be Rio going ex-dividend. Peter, what about you? We haven't given you much to comment on Rio and BHP.
Yeah, I guess I'm in the same position as Greg, because I'm holding Rio as well. It's probably my fourth biggest holding. So I'm wondering. I think it will go over 100, Paul. And the reason I'm thinking, correct me if I'm wrong, but a lot of us have dividend reinvestment plans, don't we?
Yep.
When we get this big dividend, automatically we will be buying more stocks, won't we?
Well, they are. The dividend reinvestment plan will operate for these dividends, but yeah, look, I'm not predicting the iron ore price. The iron ore price is firm. If this disruption with Vale continues, I guess it keeps on going up. So, these companies will go up as they're so dependent on the iron ore price for their share price. So, there's no reason why the Rio couldn't be $120 in 6 months' time if the iron ore price keeps going up. I just think it's sort of, it's at a 10-year high.
Yeah, that's right.
And, I think one of the other things I'd argue is that a lot of the work that happened post the last boom, that is what both BHP and Rio did, was that they sold all their unproductive assets. They put a huge drive around becoming more productive and more efficient. They cut out all their capital investment and they improved their balance sheets and drove down debt. All that hard work is now over. They can't sell any more assets, basically. They can't cut capital expenditure. They've now actually got to start to think about growth. And the largesse that's happened, all those shareholder returns are sort of over. And you see in their data they actually have now what they call negative productivity, because it's actually getting more expensive to operate. So while they go up, if the iron ore price goes up, a lot of the work that the companies themselves were doing has come to an end. So I think it's sort of almost, I won't say it's as good as it gets, but it's not too far off. So anyhow, we're sort of on the other page there. Okay, let's go to, I've got another question here I want to get to before we go to some that have come in today. Altium or Afterpay as long-term hold? You hold either, Shawn?
No, we're a dividend fund, so they're a little bit too racy for us. I mean, I watch that Afterpay price up and down almost every day by a significant amount. It's a new model, and let's see how that goes in the States. I mean, it has done well in Australia. I see people trying to replicate it, whether that's an issue or not down the track. That is it's one of those growth stocks and a big growth stock, and trying to see what the firm looks like in 5 years.
Altium's in a slightly different category, isn't it? Do you have a different view on that, or that's just?
Yeah, no, I haven't got a view on Altium.
Peter?
Well, John's not allowed to, mate. Sean's not allowed to, because he's going to chase income stocks for us. But look, Altium, Jeff Wilson told me only this week he thinks Altium is a stock to hold, so he sees it as a long-term play. And Afterpay, I think JP Morgan pushed up its target for Afterpay to $28. Look, I think there'll be a lot of volatility because, as Shawn pointed out, Flexi Group, backed by John Wiley, is going to try and eat a bit of Afterpay's lunch. I think they're a pretty good firm, and also young people don't like credit cards, and they like things like Afterpay and Zip. So both these companies, I think, are going to be around for the long term, and I think over time their share price will go up. But that doesn't mean they won't have some bad times in between.
Yeah, I think I have a slightly different view. I think on Afterpay, you just got to be careful that they take about a 4% margin, right? Most of their income comes out of the retailer paying them about a 4% margin on the transaction. So if a consumer goes and spends $100, Afterpay gets $4. Now, they've got a great model, great distribution. They've made huge growth. They're number one out there. They're the first in the market. They've got all the penetration. But when you're charging a 4% margin, you're always vulnerable to someone else coming in and doing it at a 2% margin, right? So there is no, the model can be replicated. Their success has been the strength of their distribution model and getting their technology done. So I can't say that they're not going to go up in the short term, but I just caution again, they're going to be, you're going to have a tough ride on this. So just, you need to understand the risks that you're getting into on that one.
It's for a thrill seeker.
It's a little bit for the thrill set. I mean, they've done Afterpay's credit. They've done a really good job. So you've got to hand it to them in building the distribution. But I just caution about the vulnerability of, big margins. They're not. It's not that hard to replicate the technology. The challenge is replicating the distribution. And
remember, Paul, I taught Anthony Eisen as well, so it's been really well taught.
Yep. Okay, let's just go on to the next question. We want to get some of them coming today. Franking credits, have we already seen the impact in the hybrid market, Shawn?
I don't look at hybrids too much, but I suspect that's an area that would have been impacted by, because it's hard to see why you'd hold hybrids for anything else except the franking. Banks, I think there's other issues involved there. There may be a bit of a ruffle in that market, though I think we will work our way through that.
Yeah, look, I think the question is how much of this stuff is already built in. I think it's really important that people understand that self-managed super fund trustees are only a small part of the total market here. That a lot of people this makes absolutely no impact for lots of investors. Changing franking credits has no impact on a foreign investor. It has no impact on a personal investor paying tax at more than 30%. It has no impact on most institutional investors. And for self-managed super funds and accumulation, it probably doesn't have much impact. So it's not getting rid of franking credits; it's just the refunding of the cash on excess credits.
And Paul, I think the implication of what Bill Shorten's trying to do. Sure, other people will look at REITs, and because they don't have franking credits, and they will look at hybrids, and they'll look at maybe even overseas corporate bond funds as well. But I also think it's going to make someone like Shawn Burns more valuable, because Shawn's specialisation is to know all the companies out there that pay good dividends. And even without franking credits, someone like Shawn should be able to get some really good dividend returns. If we don't, we'll sack him in the end. But that's
my point is, Peter, is you're absolutely right. The question is how much of this is already built in. Is this a classic case of, sell the rumour, buy the fact? In other words, it's already fully priced in. And there's some who argue that in the hybrid market, for example, I'm not quite with them, but that this in potential changes are already in the price. In other words, the risk now is if the change doesn't happen, or that it gets watered down in the Senate, which is very likely, I still believe. And so hybrid margins actually come down. I don't quite get you there, but my advice to anyone in this is take no action. I just don't think this is a bigger deal. It is a bigger deal to investors personally, but I don't think this is a bigger deal in terms of the pricing of securities as people have made out. So I just caution about acting too prematurely on this stuff.
Agreed.
What do you think, Shawn, on that?
Yeah, on some of the net yield, so ignoring franking on some of these stocks is actually higher than some of the REITs as well. So you're buying net yields above REIT yields, so you're still getting that pickup, so even without franking, ignoring franking.
I mean, I've always said that I think the most exposed group on this are going to be listed investment companies who are trading at a premium, and that's one of the reasons why they've started to underperform, because that's why some things like YWAM Capital are just going nowhere at the moment, because it's purely a retail market, and they were overpriced. So just be careful on those. They're probably as vulnerable as anything to a change of sentiment on this one. Okay, let's go to some questions. So we've got a lot of them come in. So the question from Mike, has Blackmores been oversold or is it in trouble?
I think it will go lower, into the 80s. I understand today it was the 90s early this week. I think in the 80s, at some point, I'd be a buyer again. It's a very good company, and it's China, the China insecurity issue that's really hurt Blackmores. I don't think Blackmores is as worrying to me as, say, Bellamy's. Bellamy's has always come up with some reason for its share price to fall. But Blackmores, they're getting a new CEO. They're getting rid of Richard Hemfrey. And so I do suspect it's going to be good buying around $80 or so, because it is certainly the best brand in the market, in the local market, when it comes to those alternative medicines. But I don't think the company shot the pieces in any way.
Okay, Shawn, not a stock that you...
We are having a bit of a look at it after this sell-off. I think that, with the CEO going, they've really struggled in China to get consistency. The contrast with A2 is pretty obvious, who've done an enormous job in China in distributing their product into China. If they ever crack that, then Blackmores ever crack that, then you'll start to get, it's a good product. They need to get their distribution into China right.
Okay, and a question from, I think it's Anush, about Telstra. Not doing a lot, Telstra, gone to sleep. What are your views on Telstra, Shawn?
I think that's Telstra. I don't think much is going to happen there. I mean, in that industry, the thing to watch is if there's any movement over the NBN. Mm-hmm. I think we've seen, because it's too expensive, it's killing the margins in that industry, and I think that we probably. If they cut the price of NBN, wrote off the asset or wrote it down severely, our Labor's talking about that, then you may start to see margins flow into the telco companies. But besides that, it looks pretty tough.
Okay. Peter, you are any more receptive to Telstra, or are you just sort of in the... You can't see much happening with Telstra in the short term?
Look, the only time I get excited about Telstra is the share price dropped to about $2.50 or something like that.
Yeah. I just think it's going to be an underperform until the two issues. Either there's something about the NBN, as you mentioned, Shawn, as an external environment, or Andy Penn can actually demonstrate that his program is working and the market starts to re-rate Telstra. And I don't think we're going to see that for a while. So I don't think you're going to get too much of Telstra. Okay. All right, another company that's been in the news is more from the Royal Commission is IOOF, stock code IFL. I mean, that on paper plays good dividends. Shawn, what do you think on IOOF?
Yeah, we had them in actually last week, or maybe earlier this week. Had the new CEO elect, I think he is now.
Has he been appointed CEO?
No, not yet.
No,
not yet.
So they're without chairman and CEO are both still down, right?
That's right. Yes, a bit like NAB, but it's that's a tricky one. I think there's still a fair bit of uncertainty there, how the advice model pans out for them. They also have to, we didn't get, the business weren't forced to separate. So advice and platforms can all still be together. That's a positive for them. There's still a lot of uncertainty hanging over that stock. And also we still need to see, I think their remediation comes out September. They're having another look at it. So we're seeing I don't think it'll be anything like the major banks who had horrendous remediation, but so it's a speculative situation. Mate, balance sheet's all fine. The other big thing, of course, is the ANZ transaction. Mm-hmm. That would be a positive if that goes ahead. They're still positive. They're still optimistic that they're doing enough to get that over the line. So that would see the share price go high, I suspect.
But not enough to encourage everyone to buy it?
I think, buyer beware. I think there's a lot of uncertainty out there, and we don't know what that remediation is. We don't know what the final wash up with APRA, etc., all is with that company, and we don't know what the advice model is going to be going forward. Yep. And they make a lot of money out of advice, so it's a bit of a question mark at the moment.
Okay, Peter, any thoughts on IOOF?
Yeah, look, I think Shawn's right. The potential remediation issues could be very expensive. If you look at the chart, Paul, it was an $11 stock before the bad news came out. It tumbled to around $4. It's now $6.74. You know, if you follow the charts, you'd be probably saying, "Oh, this company's bouncing back." $4 up to $6.74. But I still think there's a lot of issues that's going to have to confront. And I would have thought the best time to buy it was probably at $4, and would be a good time to get out at $6.74 where it is now.
Okay. All right. That question was from Tony. Leonard, you asked a question just back on franking credits. What's the first year in which refunds won't be made? It'll apply to the tax year of 1920. So it'll apply for dividends received from the 1st of July 19. Anything you receive up until the 30th of June this year will still be potentially, those refunds will still apply because it's based on a tax year. So hopefully that answers that question. Okay. Very topical stock, Bingo. Oh, wow. So I think some people say I've been wrong on this, but Shawn, probably not a stock you look at, but what did you thought? Any thoughts on Bingo?
No. Yeah, so you're right, Paul. It's not a stock that we do look at. I mean, roll-ups, just a little bit cautious on them, but that's probably the only comment I'd make. Okay.
Peter, that was from Sonia.
I've been given sort of warnings about Bingo for quite some time, Paul, and when it got sold off, I wasn't surprised. It bounced back, didn't it, later in the week? I think it's a company with too many question marks over it. Though I've got to say, they've got some pretty good contracts. But when I know there's smoke, there's got to be fire somewhere, so I'm just avoiding it.
As they say, it's a messy industry waste, and I think you've got to just there's probably a few other risks there. So unless you really think you need to own that in your stock, I think look, it's speculative at best. Let me say no more. Okay, so question from Paul on Link administration stock that I have liked, but not doing a lot. What do you think? Is that in your portfolio, Shawn?
Yes, we own Link. I think that there's a lot of little negative issues sort of out there that I think are slowly being put to bed.
So go through some of the negative issues.
I think that there's the government made consolidation of super, and they came out and said there's like a $50 million charge of that, and they're working. They've lost a couple of contracts in funds administration. They're still waiting on the REST contract, which has been pretty public. That's been going on forever. They've said that they're going to get that over the line. Hasn't happened yet. I think people are sort of waiting. But they have, that's a lot of little negatives that I think they'll work their way through those. The positives, you saw that they got a big position in PEXA. I think that looks like, and it's doing very well. In their last result, they talked that up, and it looks like it is doing well so far. They also sold part of that acquisition in the UK to fix their balance sheet. So now their balance sheet actually looks pretty good. So I think that they're working through a few issues there, but I think that you can see an end game that's falling into place for them. So we're positive on Link.
Okay. Here's a more general question.
I've got one little inside information on this as well. Julia Lee pointed out on Monday night that John McMurtry was buying Link stock. And I always like to hear when a CEO is actually putting his own money into his own company.
Yep. I mean, I've got spot on, Peter. I think that's very interesting insight. Okay. This is a more general question from, I think it's Rams, but we may have got that down incorrectly. What ASX stocks give consistent regular dividends irrespective of market conditions? So what are a couple of stocks you're just going to keep getting the dividend, probably don't have too much business risk? I can think of a couple, but I'll throw that to you, Shawn.
I mean, when you're looking at that, the two big things that we look at when we look at dividend consistency is balance sheets, like not too much debt, because debt is a killer. As soon as anything happens, a company with a lot of debt will cut its dividend. And also a consistent business model that throws off cash and doesn't vary a lot. So something like ASX has been is a pretty good payer. The REITs, the utilities, all pretty good payers. I mean, they're fairly stable businesses. and the banks have been pretty good over a long period of time as well. I think that the Royal Commission has sort of gone into that and sort of added a little bit of uncertainty last year. Now that's gone, I think we'll probably return to a lot of these companies just pumping out their dividends. So, but stable business, and not much debt, or debt commensurate with the stability of the business. That's what we look at.
Yep, I think you're bang on there. I mean, the other one, it's one of the reasons I threw Medibank in there, because also very unvolatile stock, doesn't trade the big range. But that's those type of stocks.
That's right. The only issue with Medibank that we've got at the moment is just if the AOP wins, they've obviously got that policy to cap premiums at 2%. So that'll crunch.
A stock on your radar?
Yeah, that's it's had it's obviously interesting history there. We prefer Star City, Star Entertainment.
They've got the Sydney Casino and the ones in Gold Coast?
Yeah, Gold Coast and Brisbane. So they've got Brisbane, they've got Gold Coast. They will have a competitor with Crown, Star Entertainment stock. So we can see that that's going to take a while to play out, but we can see the end game. We like it, what it looks like at the end.
Okay, Peter, any thoughts on Crown as a stock you look at?
No, I don't like Crown. I think I agree with...
More to come. Well, I'll let you go first, Shawn. I think you've got to separate the two. Possibly.
Yeah, I'd say very different cases there. I think that the banks are basically, when you look at where a lot of the problems were, is in wealth management. A lot of them are now moved out of that and shrunk that down. That's probably, I'd guess, 80% of the problems have gone in wealth management, not in actual banking at the end of it. So I think they've done some good things, AMP, though when you have a question mark over your core business like that, it's it makes it a little bit uncertain.
Do you like AMP around $2.40, or you think it's just too high? You see just high risk, is that?
Yeah, I think it's higher risk than IFL. That's our view. So
right.
if we're going to play that, we'll play it through IFL, I think, before AMP, because there's just the way those businesses are skewed.
What about the banks and the Royal Commission, Peter? Is that all over, or could there be a bit of a reversal if Billy Shorten gets the mortgage broker thing right for a change?
Yeah, look, I think Shawn's right. The banks have endured most of their punishment. I can't see any new punishment coming down the pike, apart from the fact that Shorten, I think, is going to even add more resources to AVCA, which will mean over time the banks will lose a lot more cases when consumers protest, and that will mean that their money-making activities that were unfair to consumers will reduce over time. But I don't think that's going to be a big issue. When it comes to AMP, Paul, I have the same view as I have with IFL, that you've had a bounce, anything could happen for these guys that could really damage the brand even further. And I think they're going to have to come up with something really magical to resuscitate the AMP brand, which used to be a very good brand. But at this point in time, David Murray and the new CEO haven't actually come to market with anything which makes us think, oh, we can forgive AMP. They are a trustworthy brand again. To date, they haven't done that. So I just think it's been a market bounce off the fact that the punishment from the Royal Commission wasn't as bad as we thought.
Okay, we're going to move here because we've got a few questions to get through, and we do try to keep these to exactly an hour. So let's move on. A question from John about opportunities in the aged care sector. Another one with the Royal Commission. Beaten up. More pain to come, or do you think it's a buy?
Well, they got a. It was a policy to give they just had some good news last week or the week before, I think, that some extra funding for the aged care sector. I think that we're sort of out of there. We'll see how this after the last Royal Commission. I think everyone's a bit gun shy to see what happens to this one. So I think we're out and just watching to see how that goes. Regis is a quality company in that sector, in our view.
Okay. All right. I've got a question here from Carl about thoughts on NAB Capital Notes 3 for income. I wrote about that. I think that was on Monday this week, Shawn, in the Switzer Report. I'm a buyer of those, so you can see that. Okay. A question around CSL. Almost back up to $200. I was a bit surprised when I looked at that this morning. Although I own CSL, I just hadn't taken my eye off the price. Buy at the moment?
Well, as
This is a question from Kelvin.
Yeah, I suppose we're a bit. My view is we're a yield fund. We do own some CSL. We made a lot of money out of it. We like to get a good price to take some profits and reinvest in something with a higher yield. I think it's that wasn't a great result from CSL. They are cycling some pretty tough comps there. I mean, so that people will forgive them. That IG market is growing. Has grown for a number of years and continues to grow. They're probably the only issue I have probably with CSL. We can see a little bit of a gap in their product rollout. They've been probably one of the most They have been one of the most successful health companies in the world at rolling out products over the last 2 years. When you heard the CEO, he sort of said, with these 5 great products in the last 2, that's a lot. Can they keep going at that rate? Maybe they need a breather. That's probably this negative.
So you're not in the sell category. You're hanging on, but you're not just think it's a little pricey at the moment.
Oh no!
Have we seen all the negative news? I mean, it was 220, came all the way back to 170, and it seems to have found a bottom, and it's no.
Oh well, as a yield fund, we own some CSL, not your typical yield stock. So we are looking to sell and reinvest that. So, but I think if you're a longer term investor, you're probably happy to sit and see, especially how 112 goes there, the heart attack drug.
Okay,
Peter, any views on CSL?
A year ago at 155, you and I thought this is too good to be true, and then in December when it was 177, once again we said it has to be a buy at these levels. But now you're getting to 200. I think the upside diminishes a bit, Paul. So I would say Kelvin really should listen to us a month or two ago.
Okay. All right. A question here from, I've got a couple of questions about BHP, but I think we probably covered that in the Rio discussion. But this question from Bruce, if Rio goes up, if iron ore goes up, what happens to BHP? Well, BHP also benefits. Rio, about 60% of its earnings come out of iron ore. BHP, it's just under 40, I think, from memory, maybe 35%.
Yeah, it's a lower proportion than Rio. It's got the oil business as well, and
oil and copper are other big assets. Yes. Even though it's sold, it's onshore oil. It's got a lot of offshore oil in the US.
That's correct.
So Rio's Rio has no oil and also has aluminium. So there are different drivers, but if it's straight out iron ore exposure, Fortescue number 1 possibly, Rio number 2, and BHP is number 3. So that does why it's this Vale thing that's really tipped them over the edge in terms of where they are. Okay, Ramsay reported yesterday. Question here from Sue. I thought it was a pretty good report. Do you have a look at Ramsay? Stock you own?
No, we don't own it. I had a look at it. I mean, it has. They've got a good history. I mean, I think those overseas businesses have been a little bit tougher than what they thought. That new acquisition, I wasn't too impressed with their news so far. They promised better out of that. I suppose the real issue I've got with Ramsay is just the same with Medibank Private. If Labor gets in 2% cap on the health insurers, they're going to go straight to the private hospitals and want price cuts there from them. And that's we'll see how that goes. Because if claims are going up, costs going up more than 2, you're going to get a crunch. So that's still in the future for them. So we're a bit cautious till we get a bit more clarity what that means for that whole sector.
Okay. All right. Quickly, Challenger. A question from Tom.
Yeah, Challenger.
It's a challenging stock to own, I can assure you, having portfolios, but it has actually bounced a little bit. I don't know why it's bounced where it is, but it has.
There's a couple of reasons. I think their Japanese shareholders been aggressively buying stock, and it's I think they got a further approval go to 15%, so that's their joint venture partner. Also, I think that the big exposure to credit spreads and equity markets, which were both diabolical at the end of last year, both are recovering. So you had credit spreads like sell off dramatically. Now they're coming back. So they lost a lot of money. Now they're making it. Equity markets, they lost a lot of money. Now they're making it back. So stabilising long. But it's that business model should be stable, though it can get the wobbles up every now and then if equity markets or credit markets sell off, which we may see in the future as well.
Okay, question from a stock you may not look at, but it's a stock that we haven't lost our portfolios, and Charlie Aitken likes Aristocrat. It doesn't pay much of a dividend, so I don't think it's.
No, we put that in our portfolios over that sell-off they had. We thought that sell-off was overdone. We're watching. We're positive on Aristocrat. Watch those new businesses. I think they look good so far, but it's and there's not that much expectation built in the share price, which we like. It throws off an okay yield, and it is growing. So, but we'll watch those new businesses that they stay on track.
Peter, Aristocrat. A tick from you?
Yeah, I like Aristocrat, and purely because it's just everyone likes it, but that's not really a good reason. But let's go quickly back to Challenger. Challenger did fantastically well out of the GFC. So if you buy now at a low price and you're prepared to wait 3 to 5 years, it could be a really booming stock with the next stock market crash and recession. It's the kind of thing that people chase when there's fear around the place. So that could be a long-term hold, Challenger, at these levels.
Okay, question here from, I think we might just need to close from this. We've got two more to do. Whitehaven Coal. Now, I think, should I keep or sell? I wonder if that's relating more to some of the talk around owning coal assets, but I just wonder if you've got any thoughts on Whitehaven Coal.
I've got to admit, I haven't followed the coal market. I think it's been quite strong, actually, over a lot of demand out of India, but that'll go up. I suspect it'll go up and down with thermal coal prices.
What about the environment? The sort of this other sort of campaign. You think that's a long-term risk for owning coal stocks? In other words, the campaign around the carbonisation, and we want to get out of coal as a mineral. I mean, do you? Yeah,
I mean, you can see Rio sold off its coal assets. I think when you look at, I think it's still going to play a part in the world. And Australia has clean coal. And India doesn't have much coal, so it's got iron ore. It doesn't have much coal. China's got plenty of coal, so there are export markets for that. So there's probably a part for coal to play in the future, but that it's a commodity. So I says, it's a choose your own adventure in coaling the coal price.
Okay, a question on Retail Food Group, RFG, down again today, one-way trend. I just don't like that stock. I don't know whether you.
I'm glad we looked at it and left it go to the keeper.
Okay. Any comments from you on Retail Food Group, Peter?
No, it's just mismanaged. They've got brands there that everyone uses, but this company can't generate any profit out of it, and their brand mismanagement's been disgraceful.
Yeah, maybe there'll be some. It'll be a breakup story. I don't know. So it.
Yes. Yeah, there's a little bit to be broken up.
There's a little bit to be broken up. Okay. Well, it is 1:30 Eastern Standard Time, and we try to keep these exactly to an hour because we know that you've all got commitments. And we got to pretty well every question. There's a couple of questions. One question on Appen and a question on Coronado Resources, a company I'm not familiar with, and a couple more on the potential changes from from Bill Shorten and his colleagues. And they relate to, what's going to happen. Well, as I think we said at the outset, I think a lot of this is already priced in, but it's really hard to predict the impact in markets of changes that governments might make, because this is not new news, but it's very hard to say whether the market. I still think, and I know you think this, Peter, that when this legislation, if they get elected in May, the most likely outcome is when the legislation comes to the Senate, they'll change it and they'll put a cap on it. And they'll eliminate most of the impacted people and will allow people to have 10,000 or 15,000 worth of franking credits. But we'll see what that does. But whether that translates to an impact on the prices of securities in the markets, that's. Yeah. Are you worried about that?
I'd be surprised. No, I'd be surprised if it may be transitory, but I don't think it's going to be like a big step down. For all those reasons.
And I think it's one of the reasons the banks were underperformers last year. You got to remember, this stuff is not news. It's been in the market. So I'm not necessarily suggesting you go and take any action ahead of the election would be our advice. Peter, anything you want to comment on that?
No, but on Monday on Money Talks, I'm actually going to be talking to some experts on how you should invest ahead of Bill Shorten being Prime Minister.
So that's Money Talks on not just Sky, but also free-to-air channel 95.
Yes, 95. It's called Your Money nowadays, Paul.
Right. One thing, Peter, of course, we do these on a Monday. I think we've got some big numbers in the US tonight, don't we? You'll be writing in the Switzer Report tomorrow. Have we got employment in the US tonight?
Yeah, it's usually job numbers, but I think job numbers are going to be next week.
Right. Okay. Might be because the first Friday. I think there's something like that. So what are you looking forward to tonight in Wall Street and what you'll be talking about tomorrow?
Yeah, well, look, I just think that watching this ping pong game on trade, Lightsinger, one of the negotiators, said, not going well. Then Larry Kudlow comes out and says, doing fantastically well. I do believe when the deal is eventually signed, there will be a nice little kick-up. Not as big as the Fed promise, but I think there will be a kick-up.
Okay. All right. Well, that's it. Shawn Burns, the portfolio manager of the Contango, a senior portfolio manager, say, and also the portfolio manager of the Switzer Dividend Growth Fund.
Yes.
Shawn Burns, thank you very much for joining us, Peter.
Pleasure.
Thank you for being with us. As I said, you can see Peter. Of course, you'll see his article tomorrow. From anyone who wants to get a copy of this does go up on our website, and as always, we'll be back again on the first Friday in April. Good investing. Enjoy the weekend, and thank you very much for joining us. That's all from this webinar.